Good day, ladies and gentlemen. So in this particular video, I'll be teaching you a scalping strategy that is mechanical. What that means is that it's based on simple rules, okay? So it's a mechanical scalping strategy that is based on simple rules. All you need to do is just to follow the rules, okay? So the major tool you need for this particular strategy is the Fibonacci retracement tool, okay? So all you need is the Fib retracement. For those that don't know what a Fibonacci retracement tool does, it's simply a tool that we use to gauge retracement, okay? So when you have an impulsive move, you expect a retracement if price is going to continue in the upwards direction. So this retracement is what we try to catch. So when it ends, we try to enter the market and move in the direction of the trend, okay? In the same way, we have that in the downtrend when we have a pullback like this. So that pullback is what we call a retracement. So Fibonacci helps us measure how far price could possibly go before pushing in the downwards direction. So basically, let me just get right into the system by selecting my Fibonacci tool. So I want to quickly explain something before proceeding. Okay, let me draw it the other way around. So there are some things you need to know when it comes to using this particular system I want to teach you. So I want to explain it using the Fibonacci retracement first. Okay, so look at this. When it comes to applying this particular strategy, okay, what you need to know is that you need to divide your risk into two. So we are using the Fib retracement a little bit differently than every other Fibonacci video you might have watched. So look at this. What I'm trying to say is, if your lot size that you want to use to trade based on your account size, for example, per trade you want to be using 0.4 lot size, okay, what that means is you need to split this your 0.4 into two, okay? So you'll be taking two entries per trade. Anytime you want to trade, you'll be taking two entries. Your first entry is going to be 0.2. Your second entry will be 0.2 in terms of lot size. Whereas if based on your risk management, what you want to risk on a single trade requires you to use a lot size of, let's say, 0.6, it means your first entry will be 0.3. The second entry will also be 0.3 lot size. Hope you understand. So you have to split your risk, okay? You split it into two. So you'll be having two entries. Now, why are you having two entries? You are trying to take advantage of the golden zone. And if you have an idea of how Fibonacci is used, you should know that the golden zone is between the 50% level, which is right here, and the 61.8 level, okay? So that zone in between is what we call the golden zone. So what do? When price gets to the 50% level, okay, you can see the 50 right here. When price gets there, you are taking your buy trade. That's in a buy scenario. You take a buy trade at that level with half the risk, okay? So if it's 0.4 you want to risk, you enter with 0.2 lot size at 50%. Then if it moves again and gets to 60% and 61.8% level, you enter another trade. Both trades are going to have a stop loss which you will place at the 78.6. So we are getting out at 78.6. If price gets to 78.6, it tells you that it is no longer a retracement, it's a possible reversal. So that's where our stop loss is going to be 78.6, while our first take profit will be at 0. So you have the option of taking off your trades at 0%, or you can allow it get to these extension levels of 23.6 and by 38.2 also. But I'll just advise you take at 23.6, though sometimes you can get up to 38.2. But all of those are extension levels. The main take profit position that we are 100% certain of, if it were to move in our direction, is the 0% level, which is right here, okay? So we are very certain it's going to hit that. If it's going to play out, there's certainty for this. It could hit this and then come back, but you can probably take one of the trades off at 0%, move stop loss, which is at 78, to break even, then you manage your trade to the upside. You can just be moving your stop loss upwards and upwards until you get taken out. So it's more like you're trying to use trailing stop to catch the move as much as it can go. Okay, so without further ado, let me show you my Fibonacci settings. Probably you would like to take a screenshot of that and edit yours so it will look just like mine. So this is what I have on this page. Okay, then let me go to the levels. Look at the levels down here. Okay, so I'm going to click on it to show you the levels I'm using. Okay, so use the level. You can take a screenshot of this, so when you are editing yours, you have exactly the same thing. So you can see minus 23.6, that's the extension level. 38.2, you have the 78.6, you have this, so on and so forth. So you just do a screenshot and you can edit it as you want. Let's go back. So definitely when you're done with your editing, you can come here and click on save. Okay, so let's go back. I want to give you the examples so I don't take much time. Okay, so you look for an impulsive move like this one. This is an impulsive move right here. Okay, so if it's like a buy opportunity, you flip from the bottom of the move to the top. So I'll be doing just that now. Bottom of the move all the way to the top this way. Extend it to the right a bit. Okay, I want to balance it very well, so I have that. So look at this. When price gets to this 50% level, okay, so I flip from this point to this point. So when I see the retracements coming in, I'll place my fib this way. Okay, from this point, move it upwards to this point. So when the retracement starts coming in, I'll be waiting for it to get to this 50% level. So I'll be taking my first buy right here. Then while I take my first buy here, I'll set my stop loss at 78.6 level for that first buy. Okay, then I'll wait to see if it's gonna get to 61.8. If it does, I'm taking another buy. So it's like I'm stacking my position, but don't forget I'll be using half my risk here and half here. Okay, I've explained that already. So this will be the second buy. Then the stop loss for the second buy also goes to this 78.6 level. Okay, you can see price shot up from there. I would have taken maybe one of the trades off at this 0%. Okay, the idea behind taking one of the trades off for 0% is because we expect that if price is coming up again, it will clear the liquidity up here. So it can clear that liquidity and decide to fall back. That's why I said this 0% level is where you have 100% assurance that okay, if price is going to play out, it will surely clear this part. So it can clear this part and get to 23. Any other thing it does is optional. Okay, it can decide to just clear 23 and fall back. Okay, but in this case, it cleared up to our 38.2, which is my last extension on the Fibonacci. Okay, so it gave a lot of profit in this direction. So this is also an impulsive move which can be fibbed. So I'll delete this and fib the second impulsive move. Okay, so fibbing this, since it's an upwards move, I'll fib from the bottom to the top like this. Somebody might ask, why didn't I fib up to this point here? Why didn't I stop here? Okay, why didn't I stop here? Why did I push it up to this point? It's the same reason why when I fibbed from this point to this point, I did not stop here. When all of this price action has not played out, definitely I could have fibbed from here to here. Okay, but I noticed that from here to here, price did not retrace back to the 60% level, so it just kept pushing. So since it pushed higher, I extended to this point. So at first I would have fibbed from here to here. Okay, let me do that. Let me show you. Move it a bit. Fib from here to here. So price did not get to 50% level. Look at this. price did not come back to the 50% level, then it's pushed higher. So long it has not returned to the 50% level, if it pushes higher, you need to extend the top part, this 0% level, to the next level it got to. Okay, that's the way I use my fib. So I will move this to the next level it got to. Okay, so that becomes my highest point, that becomes my 0% level. Okay, so just like before, I'll wait for price to get to the 50%, which it did right here. I would have loaded my first buy. Okay, take my first buy right here at the 50% level. Then it moved up, put me in a little bit of profit, then came down, putting me in drawdown because it wanted to get to the 61.8% level. So I'll take another buy when it gets here. So my first trade and my second trade, their stop loss is going to be at the 78.6 level right here. Okay, so as before, I can take off one of the trades at the 0% level. Okay, then trail my stop up to the next extension level, and you can see the next extension was also cleared out. So I noticed that there's also an impulsive move here which I can fib. So I'll delete this guy, I'll delete this right here and get my new fib for this. So this system works perfectly if the market is trending. So I need to be very honest with you and very open. If the market is not trending, if it's ranging, this Fibonacci system won't work too well. Okay, it can give you fake signals and you just lose some of your trades. But if the market is trending, this is a fantastic system to actually trade with. Okay, so I flip from the bottom of the move to the top of the move. So just as I've explained before, I'll do the same thing again. When price gets to 50%, I'll load in one of my levels. Why am I loading one of the trades at 50? Sometimes it will get to 50 and it won't get to 60. So I don't want to miss out. So I have to load one at 50. There are some trades where to get to 50, it won't come to 61.8. It just get to 50 and then push. So we don't want to miss out. But for an LD retracement, we need it to get to 50. There are some that will get to 23.6 and push. Those ones we don't need them. There are some that will get to 38, but we don't need them. We want the one that will get to 50. Those are the most LD ones. If it gets to 50 and pushes, then it's good. Okay, so load one at 50, the second one at 61.8. Both of them, their stop losses goes to this level, this 78.6 level. Okay, and you can see what happened. Price pushed up from there. I would have taken one of the trades off. When it clears this 0%, then allow the other one to run up to my other extension levels. You can see the way it's respecting the extension. See where it got to my last extension level, then it fell from there. Okay, so this fall is actually massive. All right, it's a massive fall right here. So but this is also, let me delete this, this is also an impulsive move. This is also an impulsive move. So I'll place my Fibonacci right here, bottom to top. Move this down a bit, down a bit. Okay, so perfect. All right, so in this case, let's see what played out. Market got to the 50% level right here. I would have loaded one trade here, then we got to the the 61.8 level. I would have loaded on that trade there, but you can see what happened. Both of them would have been taken out right here. Market got to 78.6 level, and that's where our stop loss is. So in this case, we would have lost the trade, and the reason why it played out like that was because market was about to switch. You know, an uptrend can't continue forever. So sometimes if you've taken one uptrend trade, just wait until it gives you downtrend formation, then you start looking for downtrend opportunities. But if you like, you can keep following it, but just know that it won't last forever. Every trend will always change, from uptrend to downtrend, downtrend to uptrend, and to ranging markets, etc. Like that. You know, the market is dynamic. All right, so we won, I think, about 2 to 3 trades, and we lost this particular one. Anyway, That's what I have for you in this particular video. If you got any value from this video, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.